Hi, good morning everyone. Today we'll discuss Ind AS 109, Ind AS 32, and Ind AS 107 financial instruments. Financial is monetary terms. Instrument is contract agreement. A contract where there are two or more parties legally enforceable, verbal or written, customary business practices, example purchase order or email. Terms and conditions are defined. Definition of financial asset: cash, investment in shares, equity or preference, contractual right to receive cash or bank, security deposit paid, refundable, loan to employees, investment in debentures, investment in bonds, bank balance, fixed deposit, loan given. Which transactions are not FI? DPE, capital work in progress, intangible, intangible under development, goodwill, investment property, ROU, right of use asset, deferred tax asset, advance tax, self-assessment tax, TDS receivable, GST receivable, any cess duty fee paid, ESOP as per Ind AS 102, inventory, advance paid to vendor for services, investment in gold, prepaid insurance and rent. Financial liability, contractual obligations to pay cash or bank. Example, loan borrowings, trade payables, security deposit received, debentures, mandatory redeemable preference shares. These liability, not a financial liability. Deferred tax liability, provision for tax, gratuity, leave encashment provision, provision for warranty, provision for dismantling, advance from customers. What is unbilled revenue? Where performance obligation is completed and only invoicing is left. Trade receivable, financial instrument. Uh, where performance obligation is not completed, contract assets, not a financial asset. Equity share capital, preference share capital in the nature of equity, options, warrants in the nature of equity. Financial asset, financial liability, equity. Financial asset, cash, investment in shares, contractual right to receive cash, settlement through own equity shares. Example options, financial liability, contractual obligation to pay cash, bank, settlement through own equity shares, where fixed to fixed criteria fails. Example, convertible debentures, preference shares, capital bonds. Equity, no contractual obligation to pay cash, bank, settlement through own equity shares where fixed to fixed criteria meets. Example, convertible debentures, preference shares, capital bonds. Residual value in total asset excluding liability. Equity is equal to assets minus liability. Total assets 3 lakh, total liabilities 2 lakh, liabilities 2 lakh 50,000, equity will be the balancing figure 50,000. Classification of financial assets: amortized cost, fair value through OCI, fair value through P&L. The assets can be classified in three categories. First is amortized cost at carrying value. Amortized cost is equal to carrying value of financial assets where I is computed based on EIR. What is EIR? Principal 1 lakh, interest for the first year is 10%, 10,000. Total amount is 1 lakh 10,000. Interest for second year is 10%, 11,000. Total is 1 lakh 21,000. Interest for the third year is 100. Total is 133 100. Interest fourth year is 133 310. Total amount is 134 410. Conditions to classify financial assets at amortized cost. Business model test: to collect contractual cash flows and objectives of business is to hold a fixed financial asset till date of maturity solely for the purpose of principal and interest. Principal and interest exist. Interest can be of any percentage, 10, 1% or 0%. In principal and interest shall not be linked to any index or equity price. equity price. Consumer price index, share price index, oil price index, or commodity price index price. A limited. A limited sells goods to B limited. Trade receivable A limited. Financial asset at amortized cost. Business model test okay. Solely for the purpose of principal and interest okay. Uh, sells goods 1 lakh. B limited. Trade payable. Financial liability A limited. Security deposit to B limited 5 lakh landlord. Security deposit financial asset at amortized cost. Business model test is okay. Solely for the purpose of interest. Principal and interest is okay. Interest is 0%. Uh, landlord A limited. A limited loan to employee SG financial asset at amortized cost. Business model test okay. SPPI okay. Interest at the rate of 10%. Opening balance plus transactions minus collections minus bad debts plus EIR is amortized cost. Fair value through OCI. Changes in fair value is routed through OCI to be reclassified to P&L. What is OCI? OCI to be reclassified to P&L and not to be reclassified to P&L. OCI which can be reclassified to P&L is net investment hedge, fair value as per 109, cash flow hedge, fair value of debt instruments 109, FCTR uh, uh, as per Ind AS 21, share of profit or loss or on associate JV 110 2811. Not to be reclassified to P&L, actuarial gain or loss as per Ind AS 19, revaluation surplus of PP intangible as per Ind AS 1638, fair value gain or loss on equity instruments as per Ind AS 109, capital reserve as per Ind AS 103, share of profit or loss on associate as per Ind AS 1102811. A limited investment Reliance. A limited 1st January 2022 1 lakh as on investment 31st March 22 1 lakh 20,000 investment in shares account debit 20,000 to OCI 20,000 Reliance uh, landlord 30th June 2022 one, 1 lakh 50,000 investment in shares account debit 30,000 to OCI 30,000 bank account debit 1 lakh 50,000 to investment in shares 1 lakh 50,000 OCI account debit 50,000 to retained earnings 50,000 conditions to classify financial asset at FD OCI business model test to collect and sell contractual cash flow business model test to collect and sell contractual cash flow solely for the purpose of principal and interest. So it is in amortized cost is the business model test is to collect cash flows, and in FET OCI it is business model test to collect and sell the contractual cash flow. Scenario one: investment in debentures for 5 years. Objective is to hold investment till end of 5 years. Business model test to collect cash flows is satisfied. Amortized cost. It has to be it has to be done at amortized cost. In scenario two, investment in debentures for 5 years. Objective is to sell the investment after 5 years, and whatever money is received to be invested in different business opportunities. Business model test is to collect and sell will get satisfied. Hence, it will be done at FET OCI. Accounting policy for FET OCI. Investment in debt instruments. Change in fair value to be recognized in OCI. Interest income to be recognized in P&L. Investment in equity instruments, change in fair value to be recognized in OCI, dividend income to be recognized in P&L, irrevocable exemption. If investment in equity is held for trading, fair value gain or loss to be recognized in P&L. If investment in equity is not held for trading, then there is irrevocable exemption to recognize the gain or loss in OCI or P&L. If it is held for trading, it has to be FVT P&L. If it is not held for trading, it has to be OCI or P&L at the option. And once the option is exercised, it can only change. Residual category FVTPL. Residual, no conditions attached. Example derivatives, financial assets held for trading. Summary of financial assets. Amortized cost, FVT OCI, FVT P&L. Business model test to collect and hold till maturity solely for the purpose of principal and interest. FVT OCI business model test to collect and sell financial asset before maturity uh, solely for the purpose of principal and interest. FVT P&L residual category. Irrevocable exemption only for investment in shares. FVT OCI, FVT P&L choice available with the management. 1st January 22, 31st March 22, 30th January 22. 5 lakhs, 6 lakhs, 8 lakhs. FVT OCI, investment in shares, account debit 50,000 to 5 lakh to bank account 5 lakh. Investment in shares, account debit 1 lakh to OCI 1 lakh. Investment in shares, account debit 2 lakh to OCI 2 lakh. Bank account debit to investment in shares, account debit uh, 8 lakh. OCI to retained earnings, uh, 3 lakh. DTA to be recognized. FET PNL, investment in shares account debit 5 lakh to bank account 5 lakh. Investment in shares account debit 1 lakh to PNL 1 lakh. Investment in shares account debit 2 lakh to PNL 2 lakh. Bank account debit to investment in shares account 8 lakh. Profit would go to retained earnings. DTA to be recognized. Classification of financial liability at amortized cost or FVT P&L. A financial liability can be classified at amortized cost or FVT P&L. Amortized cost default category, no conditions attached. FVT P&L, no conditions attached. Example, trade payables, borrowings, lease liability, SD received, redeemable preference shares. Example, FVT P&L is derivatives. How to compute amortized cost? Opening balance plus transactions minus payments plus interest EIR amortized cost. Equity no classification. Equity no classification is there. Financial assets, financial liability, equity. Initial recognition. Financial assets, amortized cost, fair value. FET OCI, fair value. FET P&L, fair value. Financial liability, initial recognition, amortized cost, fair value. FET P&L, fair value. Equity, no conditions attached, fair value. Subsequent recognition, uh, financial assets, amortized cost, it has to be subsequently valued at amortized cost. FAT OCI at fair value, FAT PNL at fair value. Financial liability, amortized cost, it has to be valued at amortized cost. FAT PNL at fair value, and equity is not remeasured. Transaction costs, incremental costs, example, legal costs, brokerage commission, stamp duty. A Limited purchased shares of VJ Limited for rupees 1 lakh. A Limited paid brokerage of 10,000. Purchase price 1 lakh, brokerage 10,000, cost of investment 1 lakh 10,000, accounting for transaction costs. Financial assets, transaction costs, amortized cost, capitalized, FET OCI capitalized, FET PNL, PNL goes to PNL, financial liability, amortized cost, transaction costs are reduced from liability, FET PNL, equity reduction from equity. A Limited has taken a loan of rupees 10 lakhs and transaction costs are 50,000. Loan taken for 5 years at 10% per annum. Loan 10 lakhs less transaction costs 50,000. Net cash flow 9 lakhs 50,000. Interest would method inflow 9 lakhs 50,000. Interest would be higher. A Limited interest would be higher. A Limited received ST Limited 1 lakh for 3 years. Interest rate is 0%. Market rate of interest is 10%. Day 1, first year, second year, third year total. SG account debit to prepaid SG account debit to prepaid rent 751. So 1 lakh into present value factor would be there. Present value factor is 75100. Uh, uh, and prepaid rent is 24900. To bank 1 lakh is the initial entry on day 1. PNL account debit to prepaid rent 24,900 divided by 3, 8,300. Uh, in the second year also 24,900 divided by 3, 8,300. In the third year also 24,900 divided by 3, 8,300. SG account debit to interest income 7510 for the first year, uh, 75100 plus 8,300, 8261 for the second year, uh, 9129 for the third year. This is 2400. Bank account debit to SD 1 lakh 1 lakh. Deferred tax asset to be recognized. Notes computation of present value. P A is equal to P into 1 plus R raised to the power of T. P is A divided by 1 plus R raised to the power of T. 1 lakh divided by 1 plus 1.10 raised to the power of 3, that is 75,100. Discount rate. For asset, SBI rate for similar maturity period of maturity. Liability, incremental corporate borrowing rate. Interest-free loan from holding to subsidiary. H Limited, interest-free loan. S Limited, 1 lakh. ROI 0%. Period 3 years. Answer. H Limited, loan to S Limited 79,300. Deemed investment in S Limited 2,700. To bank 1 lakh. Loan to S Limited 6344. To interest income 6344. Loan to S Limited 6852. To interest income 6852. Loan to S Limited 7504. To interest income 7504. Bank account debit to loan from S Limited 1 lakh. If loan is perpetual, then H. Now we'll discuss S Limited. S Limited bank account debit 1 lakh to loan from H Limited 79,300 to deemed capital contribution 2,700. Interest expense account debit to loan from H Limited 6344. Interest account debit to loan from H Limited 6852. Interest account debit to loan from H Limited 7504. Loan to L Limited 1 lakh to bank account 1 lakh. Now, if loan is perpetual, investment in estimated to bank 1 lakh, estimated bank account debit to loan from H Limited 1 lakh. Summary of the above points. SD accounting, interest-free loan from H Limited to S Limited, loan to employee at free or below market rate of interest, sale of goods. Difference in SD accounting, difference in prepaid rent, interest in interest-free loan Deemed investment to estimated and deemed capital contribution. Loan to employer difference in prepaid employee cost and amortized over the contract period. Sale of goods, both trade receivable and revenue at fair value. No deferred tax asset. Example, trade receivable FVA Ind AS 10 uh, fair value Ind AS 109 to revenue Ind AS 115. Trade receivable to interest income. Bank account debit uh, to trade receivable. Ind AS 32 component evaluation. First, accounting of issuer needs to be evaluated after a holder accounting to be evaluated. Discretionary dividend is equity. Mandatory dividend is liability. Redeemable instrument is liability. Convertible instrument. Where fixed to fixed criteria is met is equity. Where fixed to fixed criteria is not met is liability. Compound financial instrument. Where there is a financial asset and financial liability plus equity. In this, we have to determine the equity on the basis of financial asset minus liability. A Limited has invested 10% in convertible debentures of B Limited and conversion rate is 1 is to 1 and the conversion price is 10. As 10% mandatory interest is there, it has an element of liability. Since no fixed to fixed criteria is met, uh, since fixed to fixed criteria is met, it is equity. Hence, it is a compound financial instrument. For compound financial instrument, accounting in the books of holder, FVT, PNL, as per Ind AS 109, accounting in the books of issuer is split accounting. Split accounting is total assets minus liability is equal to equity 2 lakhs. If there are 1 lakhs transaction cost, then the same is to be allocated in the proportion of liability and equity. 8 is to 2 and then deducted from 8 and 2 lakhs. Putable financial instrument is a liability. Investment in treasury shares is accounted as reduction in equity, not to be accounted as investment in own shares. Gain or loss on in sale or purchase of equity shares is accounted in equity. Offsetting of financial asset and financial liability. There cannot be offsetting of financial asset and liability. There can be offsetting of financial asset and liability if the company has contractual right and legal right to settle it on net basis. Derivatives, forward, swaps, future options, cross currency. In case of gain, derivative asset account debit to MTM gain. In case of loss, MTM loss to derivative liability. This brings us to the end of the session. Please do like, subscribe the channel. Thank you so much.